afternoon, everyone. We are Fisher Advisory Services, and we are here today to present our evaluation and recommended steps going forward to you at Pierce Co. So today we are going to discuss who we are, go through a brief industry overview, followed by evaluation and our recommendation for next steps. Please feel free to jump in with your questions at any time. Here at Fisher Advisory Services, we have over 30 years working on M&A deals. My name is Shiza Syed, and I am the Managing Director and Head of Market Research. I have been with the firm for 8 years.
I'm Leo Masonis, Managing Director, been with the firm 10 years, primarily working in the M&A practice and overseeing, working with our senior analysts to kind of put together this valuation for you today.
My name is Samuel Blair. I'm a senior analyst at the firm, working in corporate valuations, specializing in leveraged buyouts, 8 years with the firm.
Hi, I'm Christian Savzak. I'm a senior analyst in capital markets, and today I helped with the project by contributing towards the DCF, finding synergy valuations, best case, worst case, scenarios like that.
At our firm, we specialize in numerous different services, including corporate valuation, restructuring, risk management, and mergers and acquisitions, which we are here to advise you on today. So let's go through the 3 possible options we have identified for Pierce Co. moving forward. The first option is to stick to the status quo. In this case, the family is able to retain the company. However, the downfall of this is that without capital to expend, revenue growth is not promising. The second option would be to sell the company to Broadband Co. In this scenario, you all receive the potential upside in Broadband Co.'s shares. However, there is no opportunity to grow earnings, and restrictions on stock selling could erode the equity value of the offer in the future. The third option would be to sell to private equity groups. In this case, your family gets the best of both worlds. Jack and Gina can exit the company as they have expressed the desire to do so, while Dan can roll over his ownership to execute on achieving earnings growth. Now let's go through a brief industry overview. As you can see in the graph on the left side of the slide, over the past decade, investment into network infrastructure in the broadband industry has been substantial and persistent. In 2019, this investment was $78 billion, and the investment is very beneficial for consumers because it leads to higher network speeds and more resilient networks. However, this means that broadband companies have more competition and a larger requirement for capital expenditure into network infrastructure. On the right side of the slide, we can see that competition is increasing because more broadband service providers are becoming available. And so you can see that from 2015 to 2019, the percentage of Americans with access to more than 2 providers doubled from 31% to 62%. And this means that consumers have more choice and that broadband companies have more competition overall. Now let's walk through some of the strengths, weaknesses, opportunities, and threats to Pierce Co. So a big strength, as we know, is that you serve rural populations, and these currently don't generate much interest from competitors. And so there is the corresponding weakness that these areas have lower populations and fewer potential customers as a result. And then in addition to this, the Pierce Co. is lacking the capital to invest in expanding business to serve more customers. So there is opportunity because Pierce Co. could reconsider a capital raise, and there's industry growth. And as we saw on the last slide, competition is a pertinent threat in this incredibly competitive market, but Pierce Co. has even more competitors than just broadband service providers. They are also competing with satellite-based service companies as well as traditional phone companies. Now I'm going to hand it off to Leo, who is going to kick off the valuation.
Yeah, thanks, Shiza. Yeah, great to be here and excited to break down our valuation of PeersCo. So in front of you, we have the three options that we went over. Option one being a standalone valuation of the company. Option two being selling to broadband company with synergies realized. And the third one being looking to sell to a private equity group in a leverage buyout where Dan would be able to retain 30% of his ownership. So before I get into the valuation results from each of the scenarios, I kind of wanted to just break down some of the assumptions financials we used in option one. In the standalone, you guys provided us a base 3-year projections. We actually took it out to 5 years using an average of the 3-year projection revenue growth and expense rates. So we believe the 5-year projections is a better understanding of what PeersCo would be valued at, his equity value is, and that's really based on the sentiment too that Dan could potentially move into senior management role in 3 to 5 years. So taking that into consideration, we believe 5 years gives us a better picture. That being said, we then did a DCF comparable president transaction valuation techniques to kind of understand what that equity value would be. You can see that the DCF has a higher range of potential low or that has a higher difference between the low and the high point. And that's really due to a sensitivity in the long-term growth rate and the weighted average cost of capital for PeersCo. In option two, we put some work into kind of understand what those synergies are that is going to be valuable to broadband. So in this case, we understand that there's going to be a 10% reduction SG&A. So we went ahead and modeled 10% reduction in the SG&A that we had modeled in standalone. We also understand that there'd be some CapEx that broadband would be able to forego. We don't know exactly what that would be, but that would entail some revenue growth. And although revenue growths are harder to kind of model in a scenario like this, we went ahead and tacked on an additional 2% revenue growth for the 5-year projection. So overall, when we did the DCF comparables and president, we realized that there was a $42 million added equity value when you take into consideration the synergies that would be brought to broadband. And option three, using just the standalone financials, we decided to look at a scenario where we would do a leverage buyout and be able to roll over 30% of Dan's ownership, assuming he wants to stay in the business. And we got to an equity valuation of $204 million. So all our valuations kind of gave us a good picture of where we think the value is at, but also there's nothing that sticks out to us as an outlier or too crazy. Before we kind of get into where we think you guys should go, we kind of wanted to take a look at the current broadband offer. So we know that the broadband offer is made up of 3 pieces, which is the cash, the seller note, and the share price. And in breaking this down, so if we look on the left side and starting at the top, we can look at the share offer value, which is they offered you 2.9 million shares at their current share price of $12, which comes out to a total share value of $35 million. Looking at the seller note, 5% payment in kind, which would come at the end, no interest accrued over those 7 years. So you would receive 105 million at the end of 7 years, but considering that that's not cash now, and you could potentially invest that into a 7-year risk-free treasury bond, we discounted that by the 7-year treasury yield, and the actual future value of that seller note is less than $100 million. Not significant, just nothing too crazy, but it is something to take into consideration when taking the full valuation of this offer. And then obviously there's the cash received, which you would receive today, and that is not discounted. That is $35 million cash today. What we then wanted to do was kind of understand how that offer compares in terms of applying a premium to it. So if we look in the middle, we look at alternative one. When we get an equity valuation of 162 million and broadband's offer at 169, that premium would be about under 5%. We then took the premiums paid on transactions in the communications industry for the last 3 years and came to a weighted average of 25%. So as it stands right now, we believe that you would not be receiving a fair market value premium on broadband's current offer. And they would need to increase their offer by about $33 million in equity to really be fair market value. And on the right side of that, you can see a little bit more also the sensitivity that the offer currently has based on share price. And really I think there was some concern with the share price as is, and we also take some we also have some concern with it. First off, being that at $12, the share price implies a EV to EBITDA multiple of 10.8. When we look at our comparable subset, it ranged between 6 to 8. So their share price currently would indicate that they're potentially overvalued at $12. Now, obviously, with news that they might be acquiring a company, that does improve the share price, but you can kind of see that as if they're able to get to that $18, they're still they would be about a 15 to 60% premium, which is still not market value, which we believe is more fair. But on the flip side, you can see how quickly the premium can erode just by a drop in the share price. In anything, even if it's close to the levels or higher than it has been in the $5, even $8, you're still looking at a negative premium on broadband's offer. So just kind of wanted to understand what broadband's offer is and kind of putting that sensitivity to that share price, because obviously you can't sell the stock for another 1 to 3 years. So it would be indicative that you also sell at the right time. So all those considerations kind of we think depresses broadband's equity value as is. So as we kind of get to recommendation, and without fully understanding what broadband can or how they can raise their equity value, we believe that the best option would be to sell to a private equity group with, if Dan is interested, being able to roll over 30% ownership, stay with Pierce Co. Jack and Gina, you would be able to get cash now and exit. And at the same time, having the backing of a private equity group would allow Dan to potentially execute on some of his business plans, which I believe was trying to get the EBITDA to 36 million. So having that backing could potentially lead to new CapEx, new opportunities. It overall seems to suit everybody's interests. So with that being said, I do want to turn it over to our senior analyst, Sam Blair, who's put extensive time into the LBO model and kind of laying down some of the assumptions, and he can walk you through how we would put a deal like this together.
Thanks, Leo. We thank you once again for selecting our firm as your advisor for the next step of your family's business. I'll just give appraised your firm's enterprise value at $253 million approximate dollars on the basis of a competitive 10 is multiplied by the last 12 months EBITDA, and this would give your family an equity value after accounting for net debt of $204 million approximate dollars, which is, if you'll recall, very much in line with the equity appraisal with synergies of potential mergers and acquisition with broadband company. So we think this is perfectly competitive with the potential M&A, with the upside of a potential for Dan to keep an equity stake as requested, while letting Jack and Gina sell their stakes for cash immediately. So this satisfies the needs of family members. And as you can see from our projections, if you assume that the exit EBITDA multiple is roughly in the range of what you can sell the business for today, then it fits the internal rate of return requirements of a private equity group between 15 to 25%. And we think below 10.8 times EV to EBITDA multiple, you'd be leaving some money on the table there. So it would jeopardize the internal rate of return of a private equity group if you ask for much more than 10.8. But we think that 10.8 multiple gives you a fair value for your business with agreement that satisfies the needs of all parties, with the leverage ratio of a PE group and their WACC incorporated into this model.
Thank
Yeah,
you.
so-
What questions?
Yeah.
What questions do you have?
I have a question for you guys. If you go back to that slide where you highlight the private equity valuations, there is a huge range in terms of what the private equity firms might consider the value of our business. You know, I'm not going to be real happy at 60 million, which I think was the bottom of that range. How do we get comfort that there's going to actually be a transaction at the higher dollar values, which would be more intriguing to us?
Yeah, no, definitely a fair consideration. What we would say is, I think it comes down to selling the upside of the business. So we know that, and we know that Dan believes that you guys can get to a EBITDA of 36 million by year 3. So I think it's making sure that they're able to see kind of the base case, different case scenarios, and kind of eliminating any downside scenarios and really showing that that's not as likely, so that we can sell the upside of the business rather than the downside.
Thank you.
This is Dan Pierce speaking. It looks like you're expecting me to roll over 100% of my proceeds. What if I want to take some cash out?
Sam, you want to take that?
Yeah, I think if you wanted to take some cash out, then in our projections that wouldn't significantly alter the rate of return that private equity group would expect to receive. There would be a consideration to infuse more capital from the private equity firm. And I think that you could still manage to satisfy the needs of all parties in this transaction with a slight adjustment for partial selling of your shares. So I think that we could definitely create that scenario for your family if you want to move forward down that route.
And what do you see as my role in the go forward ownership with a private equity firm?
I think given your expertise in operations, that any private equity firm would want you to be involved at the highest level to oversee the transition from your family's ownership to one that is shared by private equity yourself, and you'd be critical to the ongoing operations of the firm.
And sorry, and to add to that, I would say also at the same time, that is one thing that we would need to be careful with, is in terms of if the rest of if 2/3 of the family is exiting, is ensuring that you, like I said, that you have been prepped for this, and that, like I said, we would love for you to be able to take the full direction of this company. So there is some concern there that a group might devalue us based on the fact that they might see that there's expertise leaving. I think it's just making sure that they're comfortable with what you bring to the table, and making sure that you've been vetted for this position and this opportunity.
Thanks.
Any other questions? Okay, thanks, guys.
Thank you.
Thank you.
Thank you.